Hi, Clint Coons here with Anderson Business Advisors, and in this video we are going to discuss investing in raw land. Okay, so you're thinking about investing in raw land. Most likely you're doing that because you plan to develop the property. So the question then becomes, how do you structure that deal to make sure that you're not going to have adverse tax consequences? I can't tell you how many people that we've met over the years that have really hurt themselves with the way they've gone about their raw land investing. I mean, they've overpaid in taxes because they didn't understand the basic tenets of how you want to structure it to make sure that you're going to be taxed at the least or the lowest possible rate. So when you're going to go out and buy raw land, what I would suggest you do is create a LLC in the state where the property is located. Actually, it doesn't necessarily have to be in the state where the property is located, because raw land, initially, it's not doing anything. It's not conducting business. So truth be told, when you're buying raw land, you can set the LLC up in Wyoming, Nevada, Delaware, it can be anywhere. It doesn't really matter. It doesn't need to be located in that particular state. So I'm going to hold the raw land in my LLC. Now, when it comes to acquiring this land, the question then becomes, what is your time frame? When do you plan to start doing things, developing the property? The mistake that I see a lot of people make here is that they want to kind of get started on it right now and doing the subdivisions, but then it's still going to be maybe a year out before they actually get really serious about it. So maybe you start moving some dirt, bringing in some utilities initially, start subdividing the property out, short plat, and whatever you're going to do with that. That is a problem, okay? Because that's going to have adverse tax consequences for you. I'll give you an example. So this client came in. He'd owned a piece of raw land. It was about 50 acres in this area. It was an up and coming, it was a growing area, and he'd owned it for a few years. Now, he decided that he wanted to create a bunch of buildable lots there. So then he did exactly what I described. He started pushing through some roads, bringing in utilities, doing dirt work on the property. And then after he'd done that, he decided, you know what, maybe I ought to go get some advice on how to structure this. And he came into my office and he sat down with me. He goes, how's this going to be taxed? I said, well, unfortunately for you, it's going to be taxed at the highest marginal tax rate when you sell all this property off. And he goes, wait a minute, it should be long-term capital gains because I've held it for more than a year. Well, that's true. It could have been taxed at 20%. But the mere fact that you went out there and you started doing stuff, moving dirt on the property, as soon as you touch that property and start moving it around or subdividing it out, whatever you start doing in that context, you've now converted it from long-term capital gains investment property into ordinary income property at that point in time, because it's looked at as you're holding this property not for investment, but as inventory for your development. So what's key here with raw land is that if you can do this, if you can wait 1 year, so if you're buying it with speculation that you intend to do it in the future, wait 1 year before you do anything with your property. Just let it sit there in the limited liability company. Then when you get ready to start moving the dirt and move forwards with your project, what you need to do is this. You need to create a separate C corporation here. This is my C corp. This becomes my development corp up here. This is going to be my development corporation. Now what I'm going to do is enter into a purchase and sale agreement with my LLC. So my LLC is going to sell the property to that C corporation. And when we put these deals together, a lot of times what I'll do is we'll sell, let's say the property you bought it, let me give you some numbers here. So you bought the property for $700,000, okay? Then a year later, you're looking to sell it to the corp. You figure after you develop it and you get all these lots available, if you're going to sell them to builders or whatnot, you think it's going to generate for you $1.8 million total on the sale of this. So if this is my basis, what I might do is enter an agreement with my corporation to sell it to my corporation for $1.5 million. So by doing that now, you take the difference between 700, which is your basis, and the sale price of 1.5 million. That's an $800,000 gain that you're going to generate from selling this land to your corporation. But what's key here is that gain is not going to be ordinary income to you. That is, if you did it in your LLC, that would be ordinary income to you. Now it's going to be long-term capital gains rate. So it's going to be taxed at a flat 20%. So your total tax liability on this would be $160K. If you didn't do it this way, then it would be taxed at 37%. So you can see by those numbers here, you'd be at about $300,000. So this one strategy here, in my example, could save you potentially $140,000 in taxes. Now, when I've talked to investors before, and we talk about waiting for a period of time before you do this, they're often like, well, I want to do it right away. Yeah, that's fine. But are you going to be able to make up that $140,000 difference that you're going to save in taxes by jumping ahead right today on that deal? So you have to do the math yourself to figure out the investment if it makes sense to follow this strategy. But this is what occurs. So we put in this agreement. When I'm writing this up, sometimes we'll even put in a participating note. So if you want to even pull a little more money back out, you can write this up with some people refer to as contingent interest, that you're going to get a $1.5 million and the interest rate is going to be 10% of the profits on the sale of the property. So then once this property goes into the corp, then the corp is going to do all of this and bring in the dirt work. So the corp becomes the developer. So when the corporation sells those lots off and they generate $1.5 million, well, their cost basis in it, number one, was $1.5 million. So now they have $300,000 gain. Let's say they spent $200,000 on the dirt work and development there. So now it's $100,000 in taxable income to that C corporation, which is going to be taxed at a flat 21% at that C corporation level. So basically you're developing the land and you're keeping your tax rate down at 20% rather than the 37% you could run into if you just did it in your LLC or you did it in your own name. So what's key here? Hold the property for a year before you start moving anything around. Otherwise, it's going to be looked at inventory and you're going to blow up your deal and you're going to be paying a much higher tax rate when it comes to dealing or developing raw land. My name is Clint Coons with Anderson Business Advisors. If you want to learn more about this strategy, talk to us. Make sure you sign up for a free strategy session. Check the notes out below. I've got a link there that you can sign up and get that free strategy session to talk about how to structure your raw land investing.